Hello everyone, this is Paris. Welcome to Budgetholics. It looks like the stock market crash is finally upon us. If you're interested in personal finance, investing, and wealth building, please consider hitting the like and subscribe button, as this helps me immensely with the YouTube algorithm. Before we jump into the video, please keep in mind I'm not a financial advisor or planner, and that this video is for entertainment purposes only. If you're interested in investing, always do your own research, and if you need further help, seek the advice of a certified professional. Never rely on the advice of some random guy on YouTube. Without further ado, let's jump into the video. As I've mentioned previously, a stock market crash is a very common event. Some recent examples are the crash of '87, known as Black Monday, whereby the stock market saw the largest decline in a single day. In 1999 to 2000, the stock market crashed again due to the infamous dot-com bubble. People were investing in every company that had the .com in its name without being able to evaluate the fundamentals of that company. A bit more on that later. Finally, we had the stock market crash of 2008, fueled by mortgage-backed securities. Financiers created instruments so complicated that even they themselves could not value correctly, and this, combined with the fact that people believed that housing prices could only go up, led to the recent Great Crisis. Of course, we experienced another stock market crash last March, and since then we've seen one of the most intense bull runs the stock market has ever seen. But the past week's market crash has been a bit different. People have been moving away from growth stocks and back into value stocks. And this sort of began in January and February. As economies were opening up again, investors were taking their money out of the Zooms and the Amazons of the world and reinvesting back into physical retail, theaters, and so on. Thus the question rises, what can we do about this market crash? The S&P 500 has declined, as has the Nasdaq, as has even the price of Bitcoin, and of course the price of many major companies such as Tesla and Apple. And the simple answer is buy the dip. When you're in a bull run, preparing for a stock market crash, it's much easier to say you're going to buy the dip whenever the crash comes. However, as you see your positions getting redder and redder and losing money by the day, it's getting much more difficult to preserve your diamond hands. And this is not only true for retail investors, but also for individual investors, especially the ones who have to report every month or every quarter to their shareholders and justify the loss in the fund's portfolio. But for us retail investors, it's much simpler. And Cathie Woods gives 3 explanations of why that's so. Firstly, most of us are not relying on a benchmark such as the S&P 500, and we're not basing our performance on that specific index. We don't need to report to anyone, and we don't care about where the asset prices go in the short run. Unless you're day trading, then you most probably have a long-term perspective. This means that instead of looking at what the price is going to be in a month or a week, you're investing in assets of which the price will increase in the next 5 or 10 or 20 years, depending on when you want to cash out, if you want to cash out. The second important advantage we retail investors have over institutional investors is that we can make our own choices based on our own research. This means that we do not have to report on traditional PE metrics or price to book ratios. Instead, we can focus on the fundamentals of what the company is doing, how much it's innovating, and how likely it is to succeed in the future. This brings us to the third point. Traditional hedge funds have segregated their analysts and research teams into specific categories. And this is a problem even for the way stocks are listed. Technology is what's driving innovation in every industry, be it batteries, automobiles, financials, even food production. The companies who will successfully take advantage of developments in technology are the companies who will succeed. Let's take Tesla, for example. Traditional analysts of the automobile industry have been unable to price Tesla. The reason is that Tesla is not simply a car company. It's also a battery company, a robotics company, and an AI company. Analysts solely focusing on a single industry are bound to misprice companies such as Tesla. Instead, as Cathie Wood says, it's better to have generalists analyzing companies. Firstly, you need to understand the most important technological advancements out there, and then you can invest in stocks that use these advancements. The same holds for cryptocurrencies. And the most prominent example is Ethereum with smart contracts. If you understand what a blockchain is, then you can evaluate which cryptocurrency will utilize this technology to the fullest extent. If you've done your research and you've identified the good assets of last week or last month, then a stock market crash should not deter you. As I've said before, you can treat it as a Black Friday event. That's certainly what I'm doing. If you were comfortable holding Tesla when it was worth $800, then the fact that Tesla is at $600 just means you can buy more at a discount. The innate characteristics of a company do not change when the price changes. And tomorrow, if a company is even cheaper, you can buy more yet again. The same holds for cryptocurrencies. If you were comfortable holding Bitcoin at 58,000, then you should have no problem buying at 45 or 50,000. Treat every red day as an opportunity. Tesla is currently trading at a 33% discount. NIO is trading at a 37% discount, and even Apple is trading at 13% discount. Bitcoin is trading 11% below its highest point in February. All those examples are, in my opinion, wonderful opportunities to buy in. And that's what I've been doing over the past week. Investors, and especially trading algorithms, have transitioned from investing in growth stocks during the pandemic to value stocks. For example, selling Tesla stock and buying Ford or GM, or selling Amazon and buying Macy's. And while in the short term, this might indeed yield some gains, in the long run, it doesn't account for the innovation these companies bring. For example, according to Cathie Wood's, online retail accounts for only 20% of total retail. But on the past year, online retail grew 4 times the pace of its growth rate in the previous years. And thus even the older generations are getting much more comfortable with online retail. This is definitely a sector that's expected to grow. The recent illness only hastened the disruption innovation was going to bring. And this has always been the case. The companies who were able to innovate were the ones who succeeded, while the others were left behind. 20 years ago, nobody would imagine that the top 5 companies would be mainly tech companies. And that's because analysts during the dot-com bubble did not have the expertise to value those companies correctly. And to a large degree, this hasn't changed. But our generation is lucky. We grew up with technology and we're much more accustomed to how technology can bring about disruptive innovation. Taking that into account, it gives us a unique perspective over previous generations of analysts. Moreover, we can evaluate which companies' products we will be buying in the next 20, 40 years, which gives us another edge. And of course, as has happened before, new companies might come and disrupt our picks, but it's in our hands to identify those opportunities and act accordingly. So what should you do now while keeping in mind I'm not a financial advisor? Just keep dollar cost averaging. I have found this to be the best strategy. If a company's prospects are satisfactory to me, I just invest in it regularly, either weekly or monthly. The stock price rarely dictates my transactions. That being said, I might decrease a position to increase another one. But if a company, in my view, has a good future, I won't just cash out. In most cases, I'll just keep adding more funds every month to those assets I'm confident in. This, of course, holds for crypto as well. And if you want to get up to 8.6% more on your crypto, you can sign up to BlockFi using the link below. BlockFi is a savings account for Bitcoin, Ethereum, and other major cryptocurrencies. By signing up using the link below, you can earn up to $250 worth of Bitcoin, plus an interest rate on your cryptocurrency deposits. They're also coming out with their Bitcoin rewards card, which you might want to check out. Let me know how was the past week for you and what investment decisions you made. Be fearful when others are greedy and be greedy when others are fearful. And of course, do not succumb to fear of missing out either when buying or selling, or FUD, fear, uncertainty, and doubt. While you should always be open to criticism and discussing your positions, either in life or investing, you should never base your decisions on what everybody else is doing. Always do your own research and be confident in your opinions and valuations if those lie within your circle of competence. If not, you're basing your success or failure on somebody else. If you're that kind of person, maybe investing in an ETF is a better choice for you instead of investing in individual stocks or individual cryptocurrencies. Also, keep an eye out for IPOs. We know that a number of IPOs are due for this year, and some of the companies like Coinbase, for which I leave a link here and down in the description, are bound to disrupt their respective sectors. Until we meet again, always buy the dip and don't stop investing. Cheers.